So now let's allow or give Zach the opportunity to start, with the presentation about Crestmark and SBA financing. Thank you, Zach, and welcome.
Yeah, thanks for having me. Can everyone hear me okay?
Yes.
Okay, great. And I actually could speak to a couple of the things that we were just discussing in the past few minutes. But, my goal here is to give you kind of a high level overview of what we work on when we work on SBA loans for acquisitions. A quick background on my bank. And then I think most productive would probably be to open it up to questions. And I have a couple questions that have been submitted already. So I'll run through those. And then if anything else comes up, we can just talk through it. And I'm happy to give you as much of information as I can from, both just general information about how the SBA loan program works and also what we as lenders look at, like what you're just talking about, the numbers, what's the seller discretionary earnings, the multiple of the business is priced at, all of that stuff is important. And we think about it, from that point of view. So to give a quick background on myself and Crestmark, the bank I work for, Crestmark was founded in Metro Detroit back in the mid 90s by some bankers that left larger banks, primarily to help entrepreneurs in the Detroit area. So you can imagine a lot of automotive related smaller businesses. But we've always been a business bank, working with small and medium sized businesses. Our clients are mostly entrepreneurs. We don't do personal banking or personal mortgages. So we're very small business focused. We've done lines of credit, and as we grew over the years, we eventually developed an SBA lending group, which is what I've been part of going back to 2014. So, when I started in the group, there were 3 of us, and now there's something like 35 people in our group. So we've grown a lot, and really the way we've grown is financing small business acquisitions, like what everyone here is looking to do. So I've seen hundreds of businesses over the past, call it 7 years, all different industries. I've seen many CIMs, and I've dealt with many business brokers. So I'm happy to talk about any of that. If anyone wants any insight or get kind of the bank opinion on it. And I will, I'll go over the basics of the SBA. I assume a lot of you have probably done some research and know, the basics, but for many of these small business deals, acquisition deals, the SBA 7A program is really the best option out there. Unless you're a very large company already or a very wealthy individual already. The whole point of the SBA loan program is to offer reasonably priced, reasonably structured loans to small businesses that often don't have the hard collateral to make a larger, more traditional bank comfortable. You can't put up a $5 million building to back the loan or put up a large amount of cash. So, a lot of these loans that we do with SBA loans are technically under collateralized, but again, that's kind of the point. So, if a deal is for your average small business and you have a lease space, no real estate, those are 10-year loans. You can do them with 10% down from the buyer, which is pretty attractive. Obviously that's all pending appraisals and things, but it's allowable. There's no prepayment penalty on the 10-year SBA loans. So you can, pay them off quicker or refinance them at any time, which is a good flexibility. And Daniel, you have a question?
Yeah. I was going to ask, is there a minimum that Crestmark, would finance? For example, let's say I am looking into purchasing a business that probably transaction is slightly below $500,000. Is that too small?
No. So we'll go down to about, call it 150,000, depending on the nature of the deal. Now, if it's a very complicated deal that's only 150,000, we may pass on it. But if it's a simple refinance of existing debt, because you can use these loans beyond just acquisition financing, you can refinance existing debt, like if you have business credit cards or MCA, merchant cash advance loans or high price lines of credit. You can roll that, consolidate it into a 10-year term loan to pay it off. So depending on the nature of the request, we can go down to 150. And 350,000 is actually kind of it's a little arbitrary, but it's the SBA's kind of line in the sand where there's different rules. If you're over 350 or under 350, different fees. So we do, and that's one thing we try to do to differentiate ourselves, because any bank can really do SBA loans. But but many banks will pass on the smaller loans just because they take about the same amount of work, and you make, from the bank's point of view, you make less money doing them. But there are, a lot of small franchises, a lot of small businesses kind of fall in that, 150 to 350 range. So there's definitely a lot of activity in that space, and that's why we try to work in it when we can. And in terms of putting 10% down, a lot more people can put 40,000 down versus people that have $300,000. So it's just a bigger space, even though there's smaller bites of the apple from a lender's point of view. But we do go down, call it 150.
Okay. Zach, there's a question here from Ben. Is there a rule of thumb for building working capital line of credit into the funding?
So it can be done, again, pending appraisals. We have to get the business appraised, kind of like getting a house appraised before you get a mortgage, same basic concept. So if there's room in the value, we can either add additional funds to the term loan. So let's say, the business is 500,000, the buyer puts 50,000 down, and then we do a loan for, 475, that's 25,000 extra that we could give as working capital and fund into the operating account. So you can do it that way. Also, there is an SBA line of credit product that you can do in tandem with the term loan. And we do that at times. It's not a pure revolving line of credit where you can just draw up and down at any time kind of instantly. There is a little bit of paperwork involved, and eventually you do have to term out the balance after a couple of years. But in the first couple of years, it can be a good way to supplement the term loan proceeds. So we typically do them in tandem with a term loan, not as a standalone line of credit.
Okay. Is that responding to your question, or you also want to know about how to calculate the working capital needs?
No, I'm not going to go through that calculation here, but I was just curious, if there was a rule, in general, and I think Zach addressed my question.
Yeah, and I guess a rule of thumb is about 10%, so if it's a $500,000 business, up to 10%, call it 50,000, could be added as like working capital into the term loan. So typically we're not going to do it lopsided where, there's a $500,000 business and 500,000 working capital. The numbers just don't work out at that kind of level.
And what if the seller is not holding a note on the business?
You can do it either way. You don't have to have a note. There's good reasons to include it, and we see it. I would say probably more often than not, a 5 or 10% seller note, keeps the seller with skin in the game, lowers the bank's exposure to the deal. There's good reasons to do it, but it's not required.
Okay. And maybe just a follow-up question, if you don't mind, Zach.
Yeah, sure.
And this is really based off of a discussion I had today with a broker about a opportunity that I'm looking at. What if there is a good potential for expansion of the business, like into a new geographical area that requires, let's just say, the leasing of a warehouse and the leasing of a truck, right? Can that projected cost or funding be built into the initial funding of the project? Or does that have to be separate?
It can be. I would say it's probably typically easier to do that as like a secondary loan, buy the business and then show that there's cash flow to support more debt to expand. But you could do it up front. Obviously then you're bringing projections into play as well, because you're going to say, if we spend X amount of dollars on that new facility and new truck, how much revenue do we expect to generate? And that's something the bank will have to analyze, something you as a buyer will have to look at and, see if is there a risk there of, taking on that additional debt and not maybe generating that revenue as quickly as you'd hoped. Any revenue that's projected is going to be discounted a bit compared to actual historical performance. But if the business is valued at the right price, and if the buyer can bring a certain amount of cash to the table, or the seller can hold a significant note, there is a possibility of the funding can go to multiple things. It can be part acquisition, it can be part working capital, it could be part refinance of debt, it could be part buying a new truck. So the numbers have to shake out from an appraisal and a cash flow analysis standpoint, but it can be done.
Okay, gotcha. Thank you.
Zach, I had a question just to clarify around the working capital. So for the amount that the bank is giving to cover the purchase price in addition to their seller financing, the working capital that we could add on to the loan is in addition to the amount they're going to be supplying. So like it doesn't eat into the total amount that the bank can put up for the business purchase. Am I making sense?
I think a good way to think about it is it's kind of a sources and uses table, kind of a two-sided table that has to balance. So on your sources side, you have the buyer's down payment, potentially if the seller's financing part of the deal, and then the bank loan. And then all of that goes towards the uses, which could be acquisition, which could be closing cost, could be working capital. So, on the kind of the pool of the money on the sources side, as long as there's enough of that to cover everything, including working capital, because the seller's going to want whatever their price is, right? So they have to get their money. And if there's enough room in loan to value, which is comparing the bank's loan amount to the value of the business and to the cash flow coverage, you can then look to add more dollars to the loan to use for working capital or what have you. Does that answer the question?
I think, but let me phrase it this way. So say it's $1 million purchase. The bank puts up 80% of the purchase price and 10% comes from the seller through the seller note, and then remaining 10 comes out of my pocket as the buyer. Out of that 80% that's being put up, is that including the working capital, or can there be working capital added to that 80% to be, say, 85% now they're putting in?
Yeah, so that is okay. I understand. So yeah. I mean the bank piece, the 80% piece, we have to compare that number to the appraised value of the business. And if there's, because I guess you could lend a certain amount of money towards a business based on the price, but if the value is higher than the price, then there's more room to lend more dollars, because the price is the price. But if the bank is comfortable with what our loan amount is against the higher value of the business, then that's where you can create space to do additional, to lend additional funds towards working capital. But the cash flow and the value of the business are big drivers of how large the bank's loan can be. The cash flow of the business has to support the larger payments. And also, we don't want to be in a position where the business is valued at 500,000 and our loan amount's 500,000. We don't want to be at 100% loan to value. So those, without knowing how the business values compared to the price, it's hard to say for sure exactly how much working capital you could add. But I guess, that the bank could up its loan amount based on the value.
Okay.
And real quick, Brian, you asked about the personal financial statement earlier. Just to speak to that, it is fairly common for a broker to ask for some type of proof of funds or just, a high level overview, just to make sure, like Daniel said, that you have the cash that would realistically be required for a down payment and for post-close liquidity or other assets that could, be party to a loan if needed. So that's fairly common. And like you said, as long as you sign an NDA, you should be fine. And realistically, you want to be upfront about that, because eventually if you get through the broker and you get to a bank, eventually if you're, the bank will have to know what you have, to make the down payment and all that. So it's not a bad idea just to be totally upfront about it. And there might be certain instances where, you don't qualify for a certain business or a certain loan size, but that's fine. There's plenty of opportunities out there. So I wouldn't worry about providing that information and just be upfront about it, because eventually, I've had people that are not upfront about it. And then 6 weeks later, you find that out and we all just wasted 6 weeks, so.
Okay. Thank you.
Yeah, I have a question here on in the chat, kind of a general question about working capital on a $2.5 million business. How much would you need? It's hard to say. All industries are different, and really a good resource is either the broker or the seller on that, because they'll know how much cash they typically have on hand. And different businesses generate cash in different ways. So, some businesses really only get paid, once or twice a month. So they have gaps where they're not getting cash in. Other businesses are constantly have cash coming in every day, so there's not as big of a gap to fill. It depends on your head count. If you're having to cover float payroll or anything, or if you invoice, so you have to wait 60 or 90 days to get paid. All of that kind of factors into how much working capital a certain business needs to have. So looking at what the current owner has been doing and kind of leaning on them to say, how much cash do you keep on hand, that's probably the best way to get accurate working capital information on a specific business, because they're not all the same. Some businesses don't need a whole lot of cash on hand, and other businesses need to float 30 days worth of expenses at a time between getting big pops of revenue. So that's kind of a moving target and very kind of specific to certain industries.
Zach, I have a question.
Yeah.
Do you work with pre-approval letters?
Yeah. So we, they're typically pretty soft, right? Because at that point,
Right.
a lot of times the purpose is to get a broker or a seller to release information. And we understand that it's like part of the game. So, we can oftentimes, based on a buyer's personal financial statement, where we can see at least how much cash they have on hand, or if they have personal real estate or another business, we can say kind of back into, based on the 10% down payment requirement, say, okay, this person has $200,000, so they could probably qualify for, say, a business up to be conservative, 1.5 million, because they could put 150 down and have 50 left over. So then we can release a soft letter stating, based on review of personal information, we feel, Mr. Buyer is, pre-approved up to a certain amount, with the caveat, of course, that, until we see the business information, we can't really blanket pre-approve anybody without seeing what we're financing ultimately. But we can issue soft letters to keep things moving.
So that works as part of the question you made, personal finances and disclosure of, personal statements. This pre-approval letter is something you can also present to the business broker, right? It's coming from a bank. They have taken a look at your PFS. And even though it's not binding or not a commitment to a loan until they see the business and your actual, tax returns and all that information, this soft letter is always something good for an intro, with the business broker. That tells also from a third party what are your, financial capabilities and, business acquisition,
Okay, I was so Zach, to follow up on that, because I reached out to a couple of different banks. And so I guess when we meet with the bank, we should ask sort of what does their pre-approval letter process look like to sort of get something that's helpful for us as we're going out to different businesses, since we haven't necessarily narrowed down a specific business we're actively pursuing. We're just in initial conversations.
Yeah, I think all banks are, especially in the SBA space, some things are very similar at every bank, and other things are, different banks, like different industries, or have different, background requirements or experience requirements for certain industries, or buyers or loans of certain sizes. So it depends. But yeah, usually with a personal financial statement, a resume, maybe the last few years of your personal tax returns, just to get a feel for, what your personal income has been. With that information, as said, you can kind of back into what loan size you could realistically put 10% down on without going, all in. We typically don't want to put people in a position where they put every dollar they have in and are kind of left without any cash. It's just not a great position to be in. But with that information, you can back into a size range where most brokers are comfortable releasing information, as long as they know you've at least shared basic information with the bank. Because brokers, they, especially if a business is listed on like bizbuysell.com or one of those big sites, they could get all kinds of people inquiring about the business, and they have no way of knowing who's a legitimate interested buyer with cash versus someone who's just, kicking the tires on a bunch of listings. So a lot of times they will kind of put up that firewall of, give me a letter from the bank, and, we can do that. It can only be so strong depending on how much information we have.
Zach, a question for you.
Yeah.
So as a buyer, right, how do I get to a valuation that is close to what you as the bank would be looking at in terms of the value of the deal, right? because I'm finding that I don't want to waste time looking at something where the bank is going to come back and say, you know what, we're not even in the same ballpark, right? So how as a buyer, how do I get to that preliminary number, or what's the best way to do that?
It's a good question. I would say a general rule of thumb, because different industries are different in terms of how they're valued, but most small businesses are going to value at about 3 to 4 times the owner's annual discretionary earnings, meaning the salary they take, the car they run through the business, the whatever else personal they run through the business. So if a business, every year shows 100,000 in profit on a tax return, but then that there's a car and there's a this and that, and it gets up to say 200,000, that is really the owner benefit. That times 3 or 4 puts you in that kind of 600,000 to 700,000 range. And that's a pretty decent ballpark of where a lot of businesses will value. Now, when you look at a business listing, a lot of times they'll have a financial section and they'll show the, add backs, the expense adjustments. And those are that's information you need to have. But you also have to look at each line item and say, does that make sense? Or does it seem like they're adding back things that are legitimate business expenses, right? Because you want to be realistic about, you have to have insurance, you have to have phones, you have to have all these things, basic overhead. And sometimes you'll see brokers or sellers try to basically claim that like every expense is overstated, and at that point the financials basically aren't worth anything because they're just wrong from top to bottom. But so you want to be realistic about it and maybe be a little conservative about it, but that is part of the calculus. And like a business valuation firm that does the actual appraisal will make those adjustments to try to come up with that. They kind of call it a seller or owner discretionary earnings.
Right. Okay.
So that leads to think that when they have a number of discretionary earnings or items in that list, that's something you want to pay close attention to. So, for example, let's say an HVAC business who have vehicles for the technicians. So if the expense in vehicles is $100,000 and then they claim as SDE, half of that, it may be too much, considering, that the business has 5 or 6 vehicles. So how can you claim the owner's expense is half of the total, right? So then you want to ask for more details on each one of the items that they're claiming as SDE. Okay.
Yeah, for sure. And then it could be in that example that there's 5 old vans and 1 brand new Mercedes that the owner drives around in. And at that point, it's like, that could be half of it.
Is that part of the deal?
It often is. It often is, but that's kind of, perks of owning a small business.
Very good. So here we have a question. Can you explain how the SBA changes if you incorporate real estate in the loan? Is it true that you can amortize the entire loan project on a 30-year term?
Yes. So it depends on how the dollars break down between the business entity, which is, goodwill is what it would be considered, intangible business assets, the cash flow, versus a hard asset like either vehicles, machinery, or in this case, real estate. So if a deal is weighted towards real estate, say it's, a $1 million purchase price, 700,000 is the building and 300,000 is the business, that's weighted towards real estate. So you could make the argument to do the whole loan on a 25-year term, because most of the collateral is a hard real estate asset. You can also, depending on the breakdown, sometimes it makes more sense to kind of meet in the middle, and you can do like a 15-year term. So we, not to get too far in the weeds on it, but there's like a back end economics on the bank side, and it makes more sense for us to either do a 10-year loan, a 15-year loan, or a 25-year loan. So even though I think you could technically do like a 13-year loan, we're probably not going to do that. We would either try to put it in one of the either 10, 15, or 25 years. So you can argue for a longer term if the deal is over half real estate, is the way I would put it.
Okay.
And if it's not enough to do the whole thing on 25, sometimes you can meet in the middle and do a blend at like 15 years. And a key difference there is on the 10-year SBA loans, there's no prepayment penalty, so you can pay it off at any time. On the 15 or 25-year SBA loans, there are prepayment penalties in the first 3 years. So not that bad, but that's a 5% year one, 3% year two, 1% year three, and then none thereafter. So if you do go with one of the longer term SBA loans, that's just something to keep in mind. And honestly, I tell people a lot of times when they are looking at the real estate as well, that there's a lot more banks out there that'll do real estate, commercial real estate more conventionally. So sometimes it's worth investigating, could I buy the building with more conventional real estate debt versus putting it into an SBA loan? But the SBA can do it, and we've done it many times. So it works both ways. And when we look at real estate now in today's world, are you buying an office building that's becoming less in vogue with a lot of small businesses, or are you buying a warehouse or like a manufacturing facility that needs to be there? Buying an office might not make the most sense anymore, considering how many people work from home or remotely. But, buying a warehouse or production facility that has to be there, that's a better asset, I would say, just because you can't, manufacture something from home in most cases. So you need to have that facility, and it should have value going into the future. There's a lot of empty office buildings right now, out there.
Yep. Okay. Zach, another question. What are the specific requirements are net worth owner involvement? If it says, for example, if I were to hire a general manager and personal collateral. So what happens with a general manager? What are the requirements?
Yeah, a couple of questions there. So in terms of net worth, it really depends on the deal size, right? If you're trying to buy a $250,000, ice cream shop, the requirement's going to be different than buying a $5 million manufacturing business. So that plays into it. But we're looking, do you have the cash or the assets you could, borrow against to make a 10% down payment and have access to more liquidity post-close if you need it, either for business purposes or for personal purposes. You never know what comes up. So again, want to keep people in a position where they're not totally tapped out after buying a business. So I'd say it depends. Owner involvement, the SBA program at its core is meant to help active owners, people running their own businesses. So you can definitely have a GM, and most businesses, have daily managers or someone that's important to the day-to-day, beneath the owner. So that's very common, but they don't really like a business where, okay, my plan is to buy it and basically have nothing to do with it. I'm going to pay someone to run it for me, and I'm just going to do other things. That kind of goes against the spirit of the SBA program. So it's a little harder to get those approved, even though, the business and everything and the buyer can be strong. It's just that the SBA program is meant to help kind of active entrepreneurs that are working in the business. So even if you have someone, for example, say you have a trucking business and there's a guy that keeps the trucks running and, handles dispatch and all that for you, but you as the owner work on the finances and, try to build new contracts or build new relationships, like that's totally fine, to have someone that's a key person in the operation, or like on an HVAC company, have a couple key people that run the crews or whatever. But they want to see the buyer, the owner, be actively involved in the business one way or the other.
Very good. Thank you. We have another question. What is the optimal credit score range for borrowers?
So there's not a hard and fast rule here. I would say, and not all credit scores are created equal. You could have two similar credit scores with very different details behind them. But I would say once it gets certainly below 600, but I'd say maybe below like 620, it gets a little tricky depending on what led to that. Sometimes a person might have pretty clean credit, but they forgot about one medical bill 3 years ago, and they didn't even know it was there, and it's tanked their credit, because they didn't pay a $400 bill once upon a time. We can try to be reasonable with that type of stuff. Or if people go through a divorce or something, we can try to be reasonable if it seems like their overall credit performance has been good. But once it gets too low, I'd say below like 620, it can be a little difficult to get that approved. I would say most of our borrowers are in that 700 range, give or take.
Perfect. Is owning a primary residence a requirement or a main factor for borrowers?
It is not a requirement. And I mentioned earlier the 350,000 is kind of a line in the sand for the SBA. So if the loan amount is above 350,000 and the buyer has personal real estate, with equity in it, the SBA will require the bank to put like a second mortgage on that property associated with the business loan. If the loan amount's below 350, it's the bank's call whether or not they want to attach real estate. But once it gets above 350, we have to, and that could even extend to like multiple properties if you had a primary residence and a couple, rental homes with equity in them. Because again, most SBA businesses that are financed don't have hard collateral, so that's why the SBA requires personal hard collateral to be attached if it's there. But if you just don't own real estate, you could still do $1 million loan, and just the amount of cash and other assets you have and your background and experience and the strength of the business you're buying would have to support the loan, knowing that there's no personal real estate to pledge. So it's not a deal breaker. I mean, it's probably generally a positive just because it does add some hard collateral, but it's not required.
Very good. I have a couple other questions. Can 401k be used for down payment with the SBA? The general response is yes, but perhaps you can give us more details.
Yep, and there's actually one more question right above that one too. So I'll speak.
How do you handle bankruptcy? Yeah.
Yeah, I'll speak to that quickly just so we don't forget about Thomas's question. So we can work with past bankruptcies. There's, how recent was it? What has your credit kind of rebounded since filing bankruptcy? What led to the bankruptcy? And one kind of deal breaker a lot of the times is if when you filed bankruptcy, if other banks like business lenders took write-offs as part of the bankruptcy, that can make it hard to do another business loan in the future. But if, like, for example, someone gets divorced and gets saddled with all the debt and eventually has to file bankruptcy, and then 6 years later they have a 700 credit score, like, we can work with that person. So it's not a deal killer, but if it was like 6 months ago and your credit's in 550, then it's probably something where we'd have to say, okay, let's work on the personal credit, get that back up, and then we could talk. So more buyers percent down. So I'm guessing if I had a bankruptcy, would you have to put more down? I mean, that's a potential offset for it, but again, would want to see the details of the bankruptcy, what led to it. Were there any banks taking write-offs as a part of it? So it's a little, we treat every bankruptcy individually because there's, similar to credit scores, there's all kinds of ways to wind up there, and some you can work with and some you can't. So that's what I would say there. And then on 401ks, they can be used for down payments on SBA loans. And there's actually, there are programs that allow you to roll retirement dollars into business ventures without incurring the tax penalty for pulling the funds out early. The ROBS program is one. So there are like specialty accountants that facilitate this, and you have to create a new corporation where the money goes, and it's like a process, but there are people that can help you with that out there. So it's allowable, but it is something where you have to kind of do it the right way so you don't get penalized 10% or whatever it is needlessly for taking out funds early. How long? Yeah, we see here.
How long does it take for an SBA loan to close? So a few weeks back, we heard of a bank that they say they don't have to go to the SBA because they get audited so much that they're pretty quick in approving.
Yeah. So what they're referencing is called preferred lender status. Mm-hmm. PLP is what you'd see, out there on a lot of marketing materials. And that basically means you've done enough SBA loans as a bank that the SBA is comfortable with you approving your own SBA loans without them reading through the actual details and like reviewing it themselves. So most larger banks, my bank, most banks have that status if they're serious about the SBA space. How long does it take? It's a little bit of a moving target. What we tell people is once we've had a chance to look at the basic information from the buyer and the business and kind of have a general idea that everything looks okay, we send a proposal letter, a term sheet, applications. You sign up with us. We hook you up with one of our SBA underwriters, to run the due diligence and the valuation and everything. And from that point, typically takes about 60 days realistically to fully close. The first 30 days being, the due diligence, getting the valuation back, putting that all together and getting the loan approved at the bank. So about 30 to 40 days in, you should have approval at the bank. And then at that point, you have to pivot to the SBA, do all their paperwork, eventually bring in an attorney to drop all the closing related documents, the loan documents, and then organize the actual closing. So that whole process takes, if things go smoothly, about 60 days. The smaller loans under 350, again, if you're getting information quickly and efficiently, sometimes those can go a little quicker, like maybe 45 days. But anyone who's telling you they can do an SBA loan in 15 days or 30 days is probably not being totally upfront with you about it. It's
Unrealistic.
yeah, it's just a little unrealistic because there's just third parties involved, whether it's you're waiting on information from the seller or the seller's CPA, if they need to provide updated financials and take 2 weeks to get it to everybody, that'll cause a delay. The business valuation firms, they're third parties. So, we know about how long it takes, 2 to 3 weeks, but we have to wait for that information. So that's where you kind of can't try to under promise and over deliver on timing, and just emphasize that, getting the paperwork and information back and forth keeps things moving, and that's the best we can do.
I have posted your contact information, Zach,
Yeah.
ZM McDonald at Crestmark.com, and also the link to your company's webpage and your personal profile, so they can reach out to you. We're
Absolutely.
close to the top of the hour, and we can always extend a little bit. But since we were getting close, now I would like to also allow people to make additional questions, because those that I have been posting were received with anticipation. But guys, feel free to ask any more questions.
And I can stay past, the top of the hour. So yeah, if you have any questions, feel free to ask.
That question in terms of, so for Crestmark, are there any particular areas, or I guess what is Crestmark's specialty when it comes to sort of SBA lending, just to get it for industry specific?
Yeah, so we've become more general over time. I would say, if anything, that maybe differentiates us from other lenders is we're fairly comfortable with cash flow heavy businesses that don't have a ton of hard assets or don't have a building or significant machinery. So when we started our SBA group, one of the main industries we focused on initially was insurance agencies, property and casualty, home and auto insurance agency books of business, which are totally intangible. I mean, there's no hard assets there, but it's contractual revenue. It pretty much just kind of keeps turning year over year. You might lose a couple clients or gain a couple clients, but it's very predictable contractual revenue. And we're pretty comfortable with that, whereas other banks would prefer to have a building or something to collateralize the loan. But I mean, we, at this point, like I said, we've done restaurants, we've done hotels, we've done different retail, different franchises, manufacturing, some certain types of e-commerce businesses, that sell on Amazon. So, we'll look at anything, and it's, what does the history of the business look like from a cash flow perspective and a profit perspective? What's the buyer's background? If you're someone that's worked 15 years in a certain industry and you go try to find a business in that industry, even if you haven't owned one before, at least you're familiar with the terminology and, the general operations of that type of business. And it doesn't mean you couldn't go off the wall and, I've been an engineer for 20 years and I want to buy a pizza place. Like that could work, but it just has to, then you have to talk about, okay, well, how are you planning on running a restaurant, even if you don't have that experience directly? So we'll look at anything. And so Brian, I'd be interested to know, if we wanted to set up a call in the future, learn more about your background, and it sounds like you have a partner as well. And, what are your backgrounds and what kind of businesses are you looking at, and see if we can find something that fits, because, every business and every buyer is a little bit different. One thing I would bring up on that front is like licensing. So like for like HVAC or like any of the trades, because a lot of those businesses are like reliant on having certain licensing or certain employees on hand that have certain licensing, or else you can't bid on jobs or can't do work. We typically want to see the buyers with the licensing or have someone on the loan that does have the licensing, just so that, you're not tied to you want to buy an HVAC company where your main project manager has the key license, and then you don't get along after 6 months and he leaves. And then all of a sudden you're in a position where you can't do work and you have to find a new person with that license. And so the licensing is a big issue in certain industries, the trades specifically. So it's kind of finding a business that matches your background and experience. That's important.
Gotcha. No, that's very helpful. And then another quick question. I don't know if you can be helpful on this in terms of sort of the type of for someone that comes to you for a loan for an SBA to purchase an existing business, do you have any guidance in terms of how they set up their own company that purchases a business? So whether it be an LLC, a C Corp, or an S Corp, I'm just curious what kind of suggestions.
So yeah, so I'm not an accountant, I'm not an attorney. So I typically on those types of questions suggest, and every state is different in terms of how they tax certain types of businesses. So I would recommend speaking to a financial professional in your area that could point you in the right direction based on the type of business it is, where it is, just to make sure you're taking full advantage of any local regulations, local taxes, or not, running afoul of anything by doing it the wrong way.
Hmm.
So I would speak to a professional in the area on that. Say most commonly, mostly people form like S corporations. That's probably the most common, or LLCs if it's a small business. But it's different in every case.
Got it.
Another question here by, how do you guys approach life insurance for the owners? Is it mandatory?
Yeah, so it's a good question. It is mandatory in most cases through the SBA program, again, because most small businesses don't really have hard collateral. And in many cases, you're lending to the small business, but you're lending to the person running it, that's really the driving force behind the small business. So if something were to happen to that owner and they passed away, the SBA typically does require that there's a life insurance policy in place that's collateralizing the loan amount. So if it's a $500,000 loan, there'd have to be at least a $500,000 policy. And it can be like a term policy. The term just has to be long enough to cover the term of the loan. So it doesn't have to be like a whole life policy or something like that. But unless the business can fully collateralize the loan with hard collateral, the SBA will require the life insurance collateral to be part of the loan. And I see a follow-up here, that the life insurance needs to be in place prior to closing. So it's typically something that the buyers will be kind of working on while the bank underwrites and approves the loan, so that when you get to the end, that policy is in place, or at least is, close to in place, and they can provide the life insurance carrier can provide the collateral assignment form that basically assigns that policy to the loan as collateral. And the way that works functionally is, if the owner were to die 5 years into a 10-year loan, the policy would pay off whatever the balance of the SBA loan is at that point. And then whatever remaining benefits would go to the beneficiaries of the policy, like your family or a normal life insurance. So the bank's only entitled to whatever the loan amount is at that time, and the rest of the benefit goes to the named beneficiaries on the policy.
Just a follow-up question on the valuation and SDE.
Yeah.
Are you looking at the SDE only for the current year, prior 2 years? Is it a 3-year moving average, 2-year average?
That is a really good question. It's definitely an average. It does depend on the history of the business. If the growth has been very rapid, the last 2 or 3 years, the revenue's triple what it used to be. You have to take that into account. You can't hold that against the business that it was, 6 months old 3 years ago. Mm-hmm. But you also have to, so that's a positive that you might weight it towards the more recent performance. And I'm sure the seller is pricing it based on the recent performance. But you also then have to say, well, this business doesn't have very much longevity yet either. So while you might make sense to weight it towards the better, more recent performance, you still have to say, okay, well, this business has only been doing that for a year. Is it sustainable? And so it depends on the nature of the business, but it's definitely an average. And you will see businesses, brokers and sellers say, I just had my best year ever. It's twice what I've been doing. And now I'm going to apply this multiple to my best year ever and say that's the price. That might not work out, because a valuation company is going to look at the last 3 years and say, okay, obviously the business is growing, which is a positive, and it makes sense to maybe weight it towards the better years for whatever reasons, but you can't just discount what the business was in 2019. That's part of it too.
Okay.
So that's a good question, because you do see people kind of like price the business based on the best year they ever had. It doesn't really work that way.
And sometimes they don't average, right? They do like 10, 20, 70 or something.
Yeah, they can weight it, and it, what's the story behind the business? Like a quick example I've been working with a guy who's buying, it's one company, one entity, one tax return, but it owns 3 Jersey Mike's sub shops. And now all 3, the newest one's been open for 3 years, but if you go back 3 years to 2018, one of them was basically a startup. So the revenues were lower, the profits were lower, and that's the facts. But now what you're buying is 3 established stores that have all been there for 3 years. So you're obviously going to have to weight your value and your analysis towards what the stores are now. It was what it was in 2018, and that's still going to be factored in, like you said, maybe 10% of the value, but you're buying 3 established stores. So valuation companies, underwriters at banks take all of that actual background information into account when they look at a value and how to weight historical financial information.
Perfect.
Another follow-up question, if you don't mind, on an established franchise, is there any major difference that you look at from a valuation perspective?
Just a franchise versus a non-franchise business.
Yes.
There's pros and cons to franchises. I mean, you have on the pro side, you have the national marketing and brand recognition, the ease, when someone goes to Google whatever service, there's probably a better chance that the franchise business will pop up before the mom and pop shop. So there's those positives. And from a bank's point of view, the franchise, has standards, it's kind of training wheels that they make sure their franchisees keep the facility up to a certain standard and all that. So there's positives. On the potential negative side, some franchises charge really high royalties, where it makes it hard for the owner to grow or succeed. So it depends on the franchise. I think, you have to, from the bank side, and I would say from the buyer side, you have to review that franchise agreement that governs the relationship. How much control do they have? How often do they collect fees for marketing or whatever they might collect fees for? So there's hundreds and hundreds, thousands of franchise brands. So they're all a bit different, but I would say they're generally a positive because of the brand recognition and the fact that there is like another set of eyes, being the franchisor, kind of keeping an eye on the business and making sure things are being run the right way and reported the right way. So from a bank's point of view, that's always good.
Okay. And generally the financials with a franchisee would probably be cleaner than maybe a non-franchise, just because of the relationship between the franchisee and the franchisor?
I would say probably generally speaking, just because a lot of franchises have reporting requirements or internal systems that track revenues. So there's again, kind of a third party watching the numbers, and not just, and actually that brings up someone brought it up at the very beginning. You certainly don't have to be a CPA or an accountant to buy a business or own a business, but you definitely want to at least know enough to be dangerous. You want to understand what the income statement is, what the balance sheet is, what items affect each report. Not that you have to put those together yourself. You certainly could use a CPA or a bookkeeper. Just you want to make sure you at least can follow along with the numbers, because if you're totally reliant on another person to manage your money and your numbers, you could end up in a spot you didn't want to be in. So it's not a case where you have to be a professional accountant. It's just you should, as the business owner, be able to understand what is my monthly fixed cost, what's my overhead, what's my variable cost. Is there seasonality in my business where I do half of my revenue in the first quarter of the year and then have to kind of stretch that out over the next 9 months? All that's needs to be on your radar as the owner, even if you're not the one, in QuickBooks putting the report together. So I'd just say that as a general rule of thumb. I see a question here about business evaluators. So the SBA does not have their own, but they do have, business valuation companies like real estate appraisers or anyone else have certain certifications and licenses and things they have to keep up to date. So the SBA has rules on who you can use based on their accreditation. But most banks, us included, have relationships with half a dozen different valuation companies that some specialize in certain industries, others are more general. And, you build a relationship with them over time and work with the same teams. So the banks are the ones that engage the valuation company. So I would say, like, for example, if you were interested in getting a valuation done on a potential deal, it might be worth it to wait and try to, work with a bank, because a bank would have to do it anyway. So rather than pay for the valuation twice, it might make sense to just have it done as part of a bank's due diligence package.
Very good. So we're past a little bit, the hour. So if there are no other questions, we would like to thank Zach. And guys, please feel free to contact him directly if you have any deals. Actually, I am looking at one deal. Zach already contacted you. We'll continue that conversation, and hopefully we can have you back, again.
Absolutely.
Soon. Any last comments, guys? Well, thank you very much.
Thank you.
Thank you.
Yep.
Thank you, Zach.
I'll just say thank you.
Yep.
Yep.
Very
Appreciate
good.
you guys having me. And again, I'd be happy to join again. And, like Daniel said, feel free to shoot me an email anytime or give me a call and we'll get a call scheduled and we can talk through whatever you're working on.
Thanks so much, Zach. Thank you, everyone. See you next week.